Public equity markets are currently signaling absolute dominance. The S&P 500 is trading at record highs. This momentum is driven by measurable corporate performance. In the first quarter of 2026, corporate earnings grew more than 28%, supported by aggressive business investment in artificial intelligence and resilient consumer demand. But behind those record highs, the world's largest asset managers are executing a defensive pivot. Data from the Natixis Global 2026 Institutional Outlook Survey shows a sharp contradiction between current prices and institutional sentiment. 74% of institutional investors are now actively preparing for a market correction in 2026. These expectations vary in depth. While 46% of institutions anticipate a standard 10 to 20% pullback, a full quarter of the market is positioning for a bear market decline of 20% or more. While record earnings currently support stock prices, they are failing to offset the growth in systemic risk, leading major institutions to prepare for a significant disconnect between profits and valuations. One of the primary quantitative triggers for this institutional defensive posture is a metric known as the Warren Buffett indicator. This indicator measures total market valuation by comparing the total capitalization of the stock market against the national gross domestic product. Historically, a reading between 110 and 150% represents a normally priced or slightly expensive market. This chart shows that historical 110 to 150% range. You can see how the current market has broken past those norms to reach 220.1%, a level significantly higher than the peak seen before the 2022 market decline. This valuation level means the equity premium, the additional return investors require for holding stocks over risk-free bonds, has dropped to historic lows. These valuations are facing immediate pressure from external catalysts. Volatile energy costs linked to Middle East conflict and unpredictable global tariff policies are threatening to disrupt global trade routes. These factors are keeping inflation elevated, raising the prospect of stagflation, and compressing the timeline for these risks to impact the market. Extreme mathematical overvaluation, combined with these geopolitical shocks, has created a scenario where public market pricing is no longer supported by the underlying economic reality. For decades, the 60-40 portfolio, 60% stocks and 40% bonds, was the standard. It relied on public fixed income to provide a buffer when equity prices fell. That model is no longer effective in 2026. Because of high government debt and inflation concerns, only 7% of institutions believe interest rates will follow a smooth enough path to protect bond values. Institutions are responding by reconfiguring the portfolio into a new 60-20-20 standard. 65% of institutions now project that this 60-20-20 mix, integrating alternative assets, will outperform the traditional 60-40 model. This alternative sleeve is heavily weighted toward private investments, which now account for 78% of that specific allocation. This has led to massive capital inflows into private equity and private credit, which represent 31% and 17% of institutional alternative plans, respectively. Because public bonds are no longer providing reliable stability, institutions are choosing to move into illiquid assets to avoid the immediate volatility of public markets. While institutions are staying in public equities for 60% of the portfolio, high valuations in the United States are forcing a geographic rotation of that capital. The data shows a significant shift away from North America. 76% of institutions now plan to either reduce or simply maintain their current exposure to U.S. stocks. This map shows where that capital is rotating. 90% of institutions are now favoring Asia-Pacific stocks, while 88% are looking toward European markets for better relative value. Beyond geography, managers are also changing how they own these stocks. Passive indexing is viewed as a liability when markets are this concentrated and overvalued. 62% of institutions project that active management will outperform passive strategies in 2026. This is manifesting in the growth of active ETFs. 75% of institutional users now deploy active ETFs specifically to manage duration and tactical risk exposure in their fixed income portfolios. In an overvalued system, passive exposure creates direct risk. Institutions have made active risk management and global diversification their primary tools for capital survival. The rotation into private alternatives is designed to shield portfolios from the immediate volatility of public markets. However, the stability of these assets depends on a specific liquidity structure that the Federal Reserve is now identifying as a vulnerability. The Federal Reserve's May 2026 Financial Stability Report explicitly flags rising stress within private credit vehicles. The report focuses on semi-liquid funds, which include perpetual business development companies, or BDCs, and interval funds. These vehicles rely on a mechanic called liquidity and maturity transformation, which has created a structural weakness in the sector. These funds raise capital by offering investors quarterly redemption options, but they invest that money into corporate loans that are locked up for 7 to 10 years. This means the asset class institutions are using to avoid public market turmoil is built on a foundational mismatch between how quickly investors can withdraw money and how quickly the underlying loans can be sold. This chart from the Federal Reserve details the net flows for perpetual business development companies, plotting investor inflows against outgoing redemptions. You can see the red outflow bars growing significantly through the fourth quarter of 2025 and into early 2026. Redemption requests have spiked due to rising corporate default rates and fears that AI advances will disrupt software companies, the largest sector in many private credit portfolios. As these requests flooded in, many fund managers were forced to trigger strict 5% withdrawal caps. This effectively locked investor capital inside the funds to prevent a fire sale of assets. Look at the data for the first quarter of 2026. This is the moment where the black net flows line crosses below the zero axis. For the first time since these vehicles were created, accepted redemption requests have eclipsed new incoming capital. With public equity valuations at extremes and private markets facing liquidity freezes, elite investors are turning to a final defensive layer, the aggressive accumulation of cash. When public markets face a historic repricing and private safe havens restrict access to capital, cash becomes the only reliable tool to survive the correction and buy the eventual dip.